The payment is $389 a month. That's the number the finance manager is showing you right now, slid across the desk in a folder with the dealership's logo on it. $389. He says it like it's a fact of nature, like weather, like a number that simply exists and always has. He doesn't mention the 36 months. He doesn't mention the mileage cap. He doesn't mention the disposition fee or the money factor or the residual value, or the 7 other levers he has been trained to keep out of this conversation. He mentions $389. You sign. You will sign $389 3 more times before you understand what you actually signed. This is that story. Not a warning, not a lecture, just the math, laid out the way nobody laid it out for you in the finance office, with the new car smell in the air and the clock running and the payment that felt, at the time, like the only number that mattered. Act 1. The First Lease. You are 24. The car is a 2021 Honda Accord Sport, lunar silver metallic. It is the most beautiful thing you have ever been responsible for. The lease is 36 months, $389 a month, $2,500 down. You feel smart about it. You did research. You watched 2 YouTube videos. The logic seemed airtight. Why buy a depreciating asset when you can drive something new every 3 years for less than buying? The payment is lower, the car is newer, the warranty covers everything. You don't have to worry about repairs. What you did not calculate, because nobody handed you the full equation, is what the lease actually costs. $389 times 36 months is $14,004 in payments. Add the $2,500 down. Total out of pocket, $16,504. At the end of 36 months, you will hand the car back to the dealership. You will own nothing. You will have no equity. You will have no asset. You will have $16,504 worth of receipts and 36 months of memories and a disposition fee of $395 for the privilege of returning a car you never owned. Total cost of the lease? $16,899. The car at the end of your lease is worth approximately $16,000 on the used market. The dealership keeps that. That is the business model. You paid $16,899 for the right to use something that retained $16,000 of value that went entirely to someone else. You do not know any of this yet. Right now, you are 24 and the car is silver and the payment is $389 and life feels manageable in a way it hasn't always felt. The first rule? A lease payment is not a car payment. It is a rental fee for a depreciating asset, structured to feel like ownership while delivering none of its benefits. Act 2. The Renewal Trap. Month 33. The dealership calls, not because anything is wrong, because month 33 is when the math works in their favor, and they have a system that knows exactly when to call you. The voice on the phone is warm and familiar. She tells you your lease is ending soon. She tells you there's a great new Accord, just updated, and she can get you into it for… She pauses here, knowing the pause matters. $409 a month. Only $20 more than you're paying now. You say yes. Of course you say yes. The alternative is buying out the lease at the residual price, which feels complicated, or finding your own financing, which feels like work, or driving something older, which feels like going backward. The $20 difference is nothing. The new car is right there. The process takes 40 minutes. What just happened is not complicated once you see it. You have now been in a lease for 6 years, 2 consecutive 36-month cycles. Total paid, $33,798, plus $4,100 in down payments. $37,898 out of pocket. Equity built, 0. Assets owned, 0. The dealership has your $37,898 and is delighted to offer you a third cycle at $419 a month. The renewal trap is not a trap in the dramatic sense. Nobody forced you. The numbers were technically disclosed. The trap is structural. It is a system so frictionless that continuing is always easier than stopping. And stopping requires a decision. And decisions require energy, and the dealership has spent decades perfecting the removal of every obstacle between you and signing again. You are about to sign again. The second rule: the lease renewal call is not customer service. It is the most profitable moment in the dealership's relationship with you, And it arrives precisely when you are most likely to say yes. Act 3. The moment it cracks. Your coworker Marcus buys a used Toyota Camry. He is 29. You have worked alongside him for 3 years. He drives a 2019 Camry he paid $21,000 for with a 5-year loan at 5.9% APR. His payment is $404 a month, $15 more than your lease. The car has 31,000 miles on it. It is not new. It is not silver and gleaming and something people notice in parking lots. It is a used Camry, and Marcus seems genuinely unbothered by this. You make a small joke about it once. He doesn't take the bait. 2 years later, Marcus's loan is paid off. He now has a car payment of $0. He has an asset worth approximately $14,000. His monthly transportation cost drops to insurance and maintenance, roughly $180 a month. You still have a lease payment of $409 a month. You will always have a lease payment for as long as you keep leasing, which is the design. You do the math one night on your phone, in bed, after a conversation about money that didn't go the way you wanted it to. You add up what you've paid across 2 lease cycles and compare it to what Marcus paid and will pay over 5 years. You, over 5 years, $44,400 in payments, $5,100 in down payments, $395 in disposition fees. Total, $49,895. Assets owned, $0. Marcus, over 5 years, $24,240 in payments, $2,000 down. Total, $26,240. Asset owned, a car worth $14,000. Net cost of transportation, $12,240. You stare at that comparison for a long time. The phone screen dims. You tap it back on. You stare at it again. You have spent $49,895 on cars in 5 years. Marcus has spent $12,240. The difference is $37,655. That is not a rounding error. That is not a lifestyle choice. That is $37,655 that left your life and built someone else's balance sheet, methodically, $389 at a time, dressed up as a manageable monthly payment. The third rule: the total cost of transportation is never the monthly payment. It is the monthly payment times the number of months plus every fee plus what you do not own at the end. Act 4. The real math. You buy a car. Not because buying is always better. It isn't. Not in every situation, and anyone who tells you otherwise is selling you a different version of the same simplification. You buy a car because you finally sat down and ran the actual numbers, not the monthly payment, the actual numbers, all the way to the end. Here is what the real math looks like. Scenario A. You lease a $32,000 car for 36 months at $389 per month with $2,500 down. You do this twice, back-to-back, for 6 years. Total cost? $33,798 in payments, plus $5,000 in down payments, plus $790 in disposition fees. $39,588. Assets owned at year 6? 0. Scenario B. You buy a 2-year-old certified pre-owned version of the same car for $24,000. You put $3,000 down and finance $21,000 at 6.5% APR over 60 months. Monthly payment, $411. Total paid over 5 years, $24,660 in payments plus $3,000 down. $27,660. The car at year 5, assuming average depreciation, is worth approximately $10,000. Your net transportation cost, $17,660. And you have an asset. The difference over 6 years, adjusting for the extra year of ownership in scenario B, is not small. It is not a rounding error. It is approximately $22,000 in favor of the buyer. Now invest that $22,000 at a 7% annual return for 20 years. It becomes $85,000. That is what a lease cycle costs you. Not in payments, but in the future value of the money that left your life without building anything. But here is where it gets more complicated, because the math is never just the math. Leasing makes mathematical sense in 3 specific situations. 1. You drive fewer than 10,000 miles a year and can stay within the mileage cap without adjustment. 2. You are self-employed and can deduct the lease payment as a business expense, which changes the after-tax math significantly. 3. You genuinely cannot afford the higher monthly payment of a purchase loan, and the alternative is an older, high-mileage vehicle with unpredictable repair costs that could exceed the payment difference. In those three situations, the lease has a legitimate case. In every other situation, you are paying a premium for the feeling of driving something new and the comfort of never dealing with maintenance, and those things have a price, and the price is approximately $22,000 per 6-year cycle. The fourth rule. The lease versus buy question is not a question about monthly payments. It is a question about what you want to own at the end and whether the premium for owning nothing is worth what it costs you. Act 5. What you actually want. You buy a 2020 Honda Accord, certified pre-owned, 28,000 miles, $23,500. You put $4,000 down. You finance $19,500 at 5.9% over 48 months. The payment is $457 a month, $68 more than your last lease. This bothers you for approximately 2 weeks, and then it stops bothering you. And here's why. At month 48, the payment stops. The car does not stop. It keeps running. It keeps being yours. You keep driving it for another 3 years with a monthly transportation cost of roughly $160, insurance and oil changes, and 1 set of tires. In those 3 additional years, you will save what used to be your car payment, $457 a month. 36 months, $16,452. You put it in an index fund. You look up Marcus. He is on his second owned vehicle. He drives a 2022 RAV4 he bought slightly used. He is 3 years from paying it off. After that, he says, he'll drive it until the wheels fall off. He says this cheerfully, without any of the shame that the car industry has spent decades attaching to the idea of driving an older, paid-off vehicle. He mentions that since his Camry was paid off, he has invested what used to be his car payment every month, $404 a month for 4 years, $19,392 invested. At 7% annual return, that money is already at $22,000 and growing. He talks about it the way people talk about a system that runs without their supervision. Satisfied, unimpressed by itself, just working. You think about the $49,895 you spent across 6 years of leasing. What would have happened if you had bought a used car at year 1, paid it off in 4 years, and invested the equivalent of your lease payment for the remaining 2? The math is uncomfortable enough that you don't finish it. You've learned to be honest with yourself about what the math means without using it as a stick. The fifth rule. The most expensive car is not the most expensive car. It is the permanent payment, the lease cycle that never ends, the perpetual rental of something that is always a little newer than necessary and always, entirely, someone else's. Act 6. The decision framework. You are in a finance office again. You are 31. The folder is on the desk. The new car smell is exactly the same as it was at 24, engineered to be exactly the same, because smell is the fastest route to a decision made before the math is done. This time you came prepared. You know your annual mileage, 14,000 miles a year. You know a lease with a 10,000-mile cap means 25 cents per overage mile, an extra $1,000 per year, $3,000 over the lease term, never mentioned in the payment. You know the money factor on this lease is 0.00198, which converts to an APR of 4.75%. And you know the rate on your pre-approved bank loan is 5.1%, close enough that the math lives elsewhere. You know the residual value is 52% of MSRP, which tells you exactly how much of the car's depreciation you're being asked to absorb and exactly how much you're not. You know the disposition fee is $400. You know the total cost if you lease, drive it 3 years, and lease again. You ask the finance manager to show you the purchase numbers on a certified pre-owned version of the same model. He does. The CPO is $8,000 less than new. The payment is $44 higher per month. The loan pays off in 60 months. After that, nothing. You choose the CPO. You negotiate the interest rate down 1 point by showing him your pre-approval letter. You decline the extended warranty, not because it's always a bad product, but because this car has a factory warranty for 2 more years, and the math on the extended plan, in this case, doesn't hold. You drive home in a car that is 2 years old and will be yours, fully, legally, completely yours. It does not smell as new as the car you drove home at 24. You notice this, and you let it mean nothing, because you have learned, slowly and through $49,895 worth of experience, that the smell of a new car is not a financial event. It is a marketing one. The sixth rule: every financial decision made in a room where someone is paid to close you should be made with numbers you ran before you walked in the door. Somewhere tonight, a 24-year-old is sitting across from a finance manager. The folder is on the desk. The new car smell is in the air. The payment is $389 a month, and it feels, in this moment, like the only number that matters. He is not wrong to want the car. The want is legitimate. The problem is not the wanting. The problem is the room, the engineered environment where one number gets the spotlight and every other number waits quietly in the contract he'll read on the drive home, if he reads it at all. He will sign. Most people sign. Not because they are naive, not because the dealer is villainous, but because $389 is a real number in a real month, and the total cost of 6 lease cycles is an abstraction too large and too far away to feel like anything at all right now. But somewhere, on the other side of that abstraction, is a version of him at 30 who did the math before he walked in, who bought a 2-year-old car, paid it off, invested the difference, and now drives something paid for, assets growing quietly in the background, monthly transportation cost lower than it has been since he was 22. That version of him didn't get there by being smarter. He got there by seeing the full equation. Not the payment, the equation. The car you can afford is not the car with the payment you can afford. It is the car that costs the least when you add everything up, all the way to the end, including what you don't own when it's over. The math doesn't care about the new car smell. It only cares about what's left when the lease is up and the folder is closed and the finance manager is already on to the next one. Run the math first, then walk in. Subscribe so you don't miss the next one.